What's up, everyone? Welcome back to the Outlier Podcast. Kris and I are in the middle of talking about a bunch of random bullshit about Vol, and I would love to get back to that quickly. But before that, as always, awesome to chat with you. Welcome back on.
Thanks, Eric. It's a pleasure to be here as always.
Okay, so we were literally just talking about risk premiums across the curve, and you were saying in general you would expect to see slightly fatter risk premiums for the longer tail. Does your understanding of that, would that extend out is pretty much into perpetuity, or is there a point that you think it actually starts to roll over?
I think for S&P, typically the vol term structure is in contango when you're sort of at like normal levels of vol. So the back month vols will trade at a premium to the realized vols generally. I mean to the front month vols.
Yep.
So there just tends to be more risk premium as you go out in time.
And you're one of the only people I've seen actually discuss the difference between at the money and at the forward. And I actually had a couple conversations because it's something I actually came across in that book over there. It's kind of shaded out, but that's Options as a Strategic Investment by Larry McMillan. Good book.
Okay.
And it doesn't seem like as normal of a conversation, at least for retail. Like, I think most of the time retail is completely unaware that there's a difference,
Mhm.
marginally, depending on where you're looking. Could you talk about the difference between at the money, at the forward?
Yeah. So the it's funny. It's been a topic I've been writing a lot about this year. In general, option funding and how interest rates and cost of carry plays into the value of options. So what the at the forward is doing is it's saying so let's say your stock or your index is at $100 and the interest rates are 4%. Let's just assume no dividends. Your at the forward price is going to be 104, and it's going to be a 4% premium to the spot price 1 year out. And the reason is it has to do, it's basically a no arbitrage reason. It's, for example, if you wanted to buy a 1 year the S&P synthetic future a year in advance, right? It needs to trade at 104. Let's just say if it traded 100, there would be free money because if it traded for 100, you could buy the future, you could short the S&P at 100, you could buy the future for 100, and you would have no directional risk. You'd be long and short. And you would collect 4% interest on your short, assuming you're able to collect 4% on your short proceeds on your S&P, you would basically be earning a free 4%. And because it takes almost no, very little capital to do that trade, it's not infinite return, but it's like a really fat return, that 4%, because it doesn't take much capital to do it. So, therefore, the price that makes it so that there is no arbitrage is 104. So you would need to pay 104 for that synthetic future. And so the 104 price is the at the forward. And the at the forward price is also the price that a lot of people may be familiar with, the approximation that the straddle is zero point 0.8 of the vol. That is true at the forward, and that is where the derivation for that formula comes from, the at the forward price. So, and generally speaking, there's multiple strikes that are of major interest to option traders. The strikes are, excuse me, there's your spot price, there's your at the forward price, which is the sort of like mean of the distribution that Black-Scholes prices its options around. And then there's your 50 delta strike, because your 50 delta strike will be a bit higher than your at the forward price. And the 50 delta strike is important because it is the point at which the vega and gamma of an option are of this, that's where they're maximized. Like the maximum vega is happening at the 50 delta option. So that's why those strikes are of special interest. So again, spot, at the forward, 50 delta.
If I open the 20 Feb in SPY 106 days out,
Hmm.
walk me through what you're seeing here. So right now I see
Yeah.
Yep, 675s on the call side are a 53 delta, and then we essentially get a 50 delta at the 680s.
Okay, let me do this thing which I like to do before I look at the numbers, is I try to say, what do I think it would be? Like
Ah,
without
I
like
royally just fucked that up for you. Sorry.
no, I didn't, don't worry. I couldn't
Okay,
I
perfect.
didn't hear you fast enough. So I would say, what do I think it would be? So you said 106 days out. So that's about one third of the year. I know that a 1 year interest rate is about in the market right now in the yield curve is somewhere around 4%. I also would suspect that the S&P has a dividend yield of something in the 1.5% to 2% ballpark. So,
One 1.1.
oh, all right, I'm high. All right, so 1.1. So let's say you have a 4% interest rate, but you have to take out the dividend yield to get to the forward. So we're going to call that just 3%. So if the index, I would expect that the forward be 3% higher than the index for 1 year, but we're talking about a third of a year. So I would expect that the forward is 1% higher than the index. And if the index is 670, then we're talking about almost 677. So that's what I would expect the forward price to be. And the forward price is where the call and the put should be equal. So the mid market, so if we look at the 677 strike,
We don't have one of those. I can go to the 85s, which will probably have. Yes, there we go. I just moved us in a little bit, like 15 or 20 days or so, just so that because the weeklies have single strikes, the primary
okay.
expiration just moves in five strikes, so or 5 points.
So you cut 15 days off of it.
I did,
So that cuts 10% off of the amount of premium right in there. So let's drop it to the 676 strike.
which funny enough, I actually think the 677 was perfect here, probably because of the rest of the number estimations. But the 676 is a 51 delta on the call side,
Okay.
and put side is about a 50 delta. It's 49 and a half.
Well,
So
what are the mid-market price of the options? Do we have them here?
yeah, I see 2143 by 50. So
Okay.
2146.
Okay, and what's the mid price of the put?
Mid price of the put at 76, 2127.
Okay, so there you go. So 2146 minus 2127 is a 20 cent premium to the call. So the forward here is implied to be like we're really close. The forward there is implied to be 676.2.
Mm-hmm.
So that is the forward price, which is what did we say? We said 677 originally,
Yep.
and it's like we just said we lowered it to 676, and here we're getting 676.2. So
We'll
that's
just
that's the forward. Notice the delta. Now, what's interesting is the delta is slightly higher. So remember that that's not the 50 delta option. The at the forward option is not the 50 delta option. So here we see that the 50 delta option is a little bit higher, right? It looks like a 679 strike.
be 78.
Or 670,
Yep.
678 strike. Yeah, it's
Bouncing
bouncing
around a
around.
little bit, but yeah,
Yeah.
you.
So the 50 delta is 678, the forward is 676, and the spot is 670.3.
And what's the practical use for this information?
Yeah, I just think of the at the forward as the center of the distribution. So um it represents the sort of like the expected return of the stock in sort of a risk neutral world. So it's the 0 point of the Black-Scholes distribution. If you're looking at like the histogram,
Mm-hmm.
that you're at the forward is the 0 point. And that will matter if uh for example, it's kind of it's like if you're thinking of a spot price of 670 and you're talking about a near dated option, like the forward doesn't really matter. It's going to be close to 670, but it's a little jarring when you look out and you're like, wait a minute. Like if I look out a year in advance, it's like 4% higher than 670 is call it 20 $25 or whatever. It's like wow, the forward's like way way up there, And it looks weird if you're not aware that that's kind of how this works. Like you'd be like, why is the $700 synthetic, the one that costs zero, the call and the put are the same, the call and the put are the same value on like maybe like the 700 strike. But you would be like, well, wait a minute, shouldn't the put be worth way more? Because it's like it's $25 in the money.
Hmm.
So it's like it looks like option prices could like look confusing to you if you don't understand like, oh no, that actually makes sense because that's the point where the synthetic is worth zero, meaning that the call and the put are worth exactly the same, even though the put is $25 in the money. So that's I think the practical use of it there is just, it's the center of your distribution. You're thinking about terms sort of like probabilities, but it's also just to make sense of the option chain when you're looking at it.
Yeah, that's absolutely awesome. And another thing that I don't know if you've written about, I presume this is part of your broader sphere. Correct me if I'm wrong, but sometimes people will ask me when looking at a platform like this is a good question, which is like, why is it that sometimes your deltas for the calls and puts can add up to greater than one? Which typically opens the conversation between spot delta, forward delta. But I'm curious the way that you would describe that reason.
Yeah, there's I'll point to two reasons why that can happen. Um, one thing is one thing is that depending on the platform and how they're computing the implied vols, if they're just using the mid market of the option and they're giving it a rate. Like when you compute like a Black-Scholes, like you can give it an interest rate. But the other thing you can do is you could have like worked backwards and said, let's assume put call parity is true. So if put call parity is true, that is the same thing as saying I must make the implied volatility on the call and the put exactly the same. So what happens is then you can back the rate out that must make that true. That's just sort of like the professional way to build a vol surface is to start with the premise that put call parity is true. But that's not how a lot of platforms might do it. What they might say is, I'm going to give it a 4% interest rate and then look at what the call implied vol is and what the put implied vol is. And what if you just do that, but let's say the market's implied rate is a different number than the one you give it, what will happen is you're going to get a different call vol and a different put vol. And once you have like a different vol on both, well, now we can see that the deltas don't necessarily have to be coherent anymore. So we're just running a different vol on each both the call and the put. So that in itself can create sort of like if you have a really high call vol, it might just give that option like a really large delta. And because the call vol and the put vol are not the same, there's no reason that they need to add up to one. That's one. That's one reason. The second reason you can have deltas that don't add up to one is the actually, if you think about the delta of a synthetic, it actually is greater than one. Because again, we can go back to our example. We'll use our fake stock that's $100, and the synthetic future is 104. But let's say that we doubled the price of the index. So the index goes from 100 to 200. Interest rates are still 4%. Well, the synthetic is now 208, right? It's the 4% of 200 is added to it. It's 208. So the synthetic, the underlying moved $100. The synthetic went from 104 to 208. It went up by $104. So if the underlying moves $100 and the synthetic moves 104, then it actually acted on a 1.04 delta. So by literally the definition of delta, like change in option divided by change in underlying. So just from that fact, we know that the delta can be greater than one on a strike. And that's because what's happening here is the delta is actually one plus the interest rate on
Mm.
the synthetic. So if the combined delta of the long call short put is greater than 100, then your call plus your put don't have to be 100. Or they don't have to be zero, like the delta
Right.
on, right. Yeah. So that's the other reason. It just comes back to the cost of carry.
Now, when you're trying to compute or playing with different vol surface models, obviously they can get like pretty complex pretty quick, especially as you start accounting for difficult factors, jumps, diffusion, things like that. When the broker is just plotting, whatever the current implied vol is, on the back end, the actual pricing mechanics for the market maker who might be providing the quotes,
Mhm.
what kind of games are they playing to actually hide the vol that they actually think it is versus what they're laying out?
Well, I don't think that I wouldn't say that they are hiding the vol. I just think, vol is just this attempt to be sort of a measuring stick. It's not, you know, a, at the end of the day, you're trading prices. Your P&L comes down to a price. Like, you know, my P&L is how much of this option's price change times the size of my position. Vol is a way to sort of normalize across things so that we can make a coherent comparison between different options. But it's not really anything that comes into play, at least in equity options, between the broker and the market maker or anything like that. Like the broker doesn't say to you, I'm going to pay 22 vol. Now in FX, they do that. So in FX, um, and I was never, an over-the-counter FX trader or anything, but I know that in FX, they do quote things in terms of vol. And so a broker could say, I'll pay you 7% vol, and the market maker could say sold, and they're actually trading a vol number, not a price. But I would imagine in that market that they've kind of, coalesced on a convention so that they make sure that they know what price they're trading at. Because again, at the end of the day, price determines, your P&L, and that's what everybody cares about.
Yeah, and I guess to clarify that question,
Mhm.
I'm thinking more in terms of the bid ask that's offered and actually shown like, hey, you can transact at these prices. That's obviously going to yield a vol based on, like we're saying, the broker might use the mid price or whatever. But I assume there's a competitive game being played between different market makers in terms of knowing what other people are pricing vols at versus what you're pricing vols at. And sometimes, and I don't know if this is connected, sometimes I'll find happen literally just today
Mhm.
where I'll go to get a fill and I'll even go to the bid or the offer. I won't even play the middle because I know it's not happening there. I'll go either or. I'll be within the size and then nothing. So then I'll, just slowly walk it, but I can see that there's something being offered. Maybe it's being consumed by other people in the queue. I can't see them in TNS. Maybe they're there. But then
Mhm.
I can see like there's actually a price that they want to transact at that seems different than the price that I'm seeing quoted. So then I immediately assume there's some sort of gamesmanship going on between the different market makers and liquidity providers in terms of what they want to show on there versus what they want to transact at.
Oh
Is
yeah,
that
I think yeah. So I would say all market makers have all kinds of different strategies for how what they want to show versus what they want to trade. Like for example, and I would like we'll just kind of depart a little bit from the implied vol part because I don't actually I think the implied vol part of it is just very specific to each firm. Like every single pair of option price, stock price, whatever interest rate the firm wants is running based upon like what their prime brokerage situation is and what their stock balances are, right? Because like, are they pricing this option off of the long rate, off of the short rate? Like all of that stuff is idiosyncratic to the firm. I mean, this kind of gets back to like when you're pricing an option, we make all these shortcuts where we're like we act like as if there's one risk-free rate, but like
right?
there's lots of rates and everybody has a longer short rate and it's all a lot more detailed than that. But let's just So the implied vol, we can just say like, hey, whatever broker platform you're using has some implied vol, whatever analytics you're using has some implied vol. I would say that we didn't really care what implied vol was given to us by any vendor, like in a professional setting, because we were just going to take all those numbers and translate them into our internal way of looking at vol,
Right.
which we needed to do because, especially if you trade cross asset, different assets have different calendars. So it's like, crude oil expires, say like, uh, whatever is it, an hour and a half earlier than the equity market, like is the settlement time for crude. So, a European option on crude like settles like 2:30 p.m. Eastern time, and equity options settle at 4 p.m. Eastern time. So you may have how you figure out what vol corresponds between like USO and crude oil really kind of depends on like how much time is left in the day. Vol depends on how much time is left. And so there's different amounts of time left in each one of those options. So everybody can have a different vol. And you have to have in a professional setting where you're trading for like small margins, you're going to have a very detailed approach to how you look at the vol. Separately, execution strategies can be uh, you could have your people are streaming, and then in the context of streaming, you may have this is what the bid ask you're willing to sort of show. And now one of the things that happens is you show the bid ask, and like people don't generally want to trade really large size with an electronic order necessarily because of adverse selection problems. So you want to show an amount of you want to show like a certain amount of size that you can trade. You don't want to get picked off. However, based upon like the queuing rules at the exchange, like if you have a pro rata exchange, which says um, your the amount you will be filled on, let's say 100 contracts comes in to buy, and uh, a typical queue is like first in, for whoever's first on the order book gets the, if you place 200 contracts on the offer on your order book and you're the first person to do it, and 100 lots comes in to buy, you get them all. But on a pro rata exchange, it could be the case that everybody's on equal standing and your fill is pro rata to how much size you show. So if you have five market makers who each show 200 lots on the offer for 1,000 lots of total size on the offer, and everybody's showing 200 each, they are all entitled to 20% of the order that comes in. So 100 lots comes in to buy, everybody gets 20. You're just going to get your pro rata there. So what's happening there is when exchange does that, it's incentivizing you to show more size than you want to trade because you really don't want to trade 200 contracts on the offer necessarily. There are various metrics about like how many, when these market makers study this stuff, like how many lots, if you trade over 15 lots, you start to see adverse selection in it. So like ultimately they just want to trade against like small orders, right? They just want to trade against retail ones and twos. They're happy to trade against that. So but in this case, they're being incentivized to offer more than they want to by the exchange's rules. But there are other situations where the bid ask is always a game because you're framing a market. You're trying to paint a picture. And if you're trading something super liquid, there's not a lot of room for gamesmanship. Like because there's so much order flow that if you show like a quote unquote like low market, there's so much flow that somebody might come in and lift you. But if you trade something that's relatively illiquid, uh, and you know that the next order in this name is like 75% to be a seller, then if fair value is $5, you might make your market 480 bid offered at $5 instead of making it 490 bid at 510. So you're going to frame your market. And what will happen in that case is let's say you make the market that way, but you set an electronic eye that says if something comes in offered at 490, take it. So don't show 490 bid, but if offered at 490, then lift. So
Mm.
that's how. So a market maker is going to have these electronic eyes that have it to their real limit inside, hidden from the marketplace. But at the same time, there are then platforms, execution platforms that you can like off the shelf stuff that you can get. Like Spider Rock is sort of like probably the most famous one in equity options, where they have algos themselves, which allow you to stream your quote. So basically, to move your bids and offers on options based upon how the stock price is moving. And then also give you all kinds of functionality like auto hedge. Like if I get hit on these calls, go out and sell the shares. If I get hit on these calls, go out and leg this other option. And then they will have different levels of aggression. They will have electronic eyes. I mean, they're trying to give you as much. They're trying to give you as close to the tools that market makers probably already have built in-house. They're just an off the shelf version of that. So that's but the whole game of bid ask is definitely a game, but there's a lot more room for that little poker match if something is less liquid. If there's just like tons of two-way flow, I mean, you don't even need a market maker as much if there's tons of two-way. If you have enough like liquidity in something, you don't like a market, there's very little room for a market maker to sort of like insert themselves into that.
Right. Super interesting. And you mentioned something before that I want to follow up on in a slightly different context, which is like what the market maker or whoever again is providing liquidity there has in their book. And there's a like retail autistic level of focus on stuff like Gex, Dex, Charm, Vanna, and a lot of these different tools that it seems like retail think that these are like novel new stuff, and maybe for them it is, but obviously it's stuff on the institutional side you guys have been looking at and working with for some time now. The main question I have here is my hypothesis with stuff like that has always been it's of exceedingly limited utility. And it goes back to what you were talking about before. The fact that if we look at Gex or Dex, we would assume some sort of behavior on the end of whoever's providing that liquidity, but that also has a massive assumption that they don't have other stuff that's interacting with that individual position, thus actually leading to a different behavior. Could you talk a little bit about just general concepts around those kind of metrics, gamma exposure, delta exposure, and one, if you think that there's any actual practical utility for the retail side of the world, but then also your rendition of like how they actually work and how they impact things?
Yeah, it's a big question. Let me there's a lot of layers to it. So I'll start with I'll start with the first of all, like the outstanding amount of gamma, like these things absolutely they matter. Like as far as if there's a bunch of short gamma in the market and the starts running there and the short gamma is held by hedgers, they're going to have to respond. So you can always kind of you can think of Greeks as sort of like an order book through time in a way. But so it's true that that these things matter. I think it's very difficult to tell how they matter. Like for example, it's because the problem is like adversarial. It's if you think about how somebody has to generate those metrics, like there's this much gamma. What they're doing is they're saying there was this much options bought or sold in this region of the surface. And we know that the deltas of those options are this. But are those are deltas that they got from where, first of all? Like the market makers may not be running the exact same deltas. There could be certainly be variations. I mean, I've certain like I used to run deltas on my books that were like five deltas different on an at the money than they were in the marketplace for oil. So so that's one is like your deltas themselves are could easily have like sort of like a 10% variation in them, especially like a sort of like at the money. The other thing is that well, and the bigger problem is like there's you're saying that the market makers are short. Like this is the example I use. Like you look at this and you say, well, look, market makers are short like all these 30 delta S&P puts, let's say. But market maker's job is not to just like nakedly sell these S&P puts, right? It's like so they're like out there buying single stock puts against it. Like they're pricing the S&P puts versus where they can get liquidity in something else. Like to a market maker, the price for anything is dependent upon the price of where like their offer for anything depends on where something else is offered. So if they're running a book where they sell a bunch of 30 delta S&P puts and they go out there and they buy a bunch of 30 delta single stock puts against it. Now you've got the situation where, well, first of all, what do you think the outstanding gamma in the market then is? Like they've bought and they've sold. So like, are you only showing me half the picture where you're not showing me that there's all this other single stock gamma? That's one. So this is like and the thing is, that's a snapshot right there, 30 delta on both. But now the market starts moving around. Everything starts doing its own wiggles. So let's say that the S&P, that 30 delta put, it's like down 10%. Let's say the S&P drops 10%. And let's say that the single stocks that drop, they underperform on the sell-off. So the stocks drop even more, meaning on that sell-off. So now you have gotten to short your short gamma on your S&P leg, and you've went blown through the strikes on the single stock leg. So the market makers have like done very well on the move. But at this moment, at this snapshot in time, they are the market makers are now short an in the money put, or equivalently an out of the money call, and they're long those, and they're short at the money S&P puts now because we're sitting on their short strike. So now they started off hedged. Maybe they were overhedged, by the way. Like you're like, hey, there was all this short gamma down there, but like, how do you know the market makers didn't overbuy single stock? So maybe market makers were actually net long gamma on the move, and here you're advertising that they were short, but they were actually long because you're not showing that side of the picture necessarily. And then when we move down there, now the market makers are short because their shorts are at the money and their longs are in the money puts. So accounting for all this is just a very difficult problem. And then and then here's what complicates it even further. Let's take this example and say, first of all, the market makers know because the skew will even tell you if put skew is super jacked, more than it's always a premium, but it's even more of a premium to that. That's because there's buyers. So the market makers are first of all, I didn't need Gex to tell me that the market makers were short those puts because they're really, really expensive compared to their own history. So how did they get expensive? Well, somebody bought them from the market makers. So the market makers know that there's a bunch of short puts down. There's a bunch of short gamma down there. So now they have to think to themselves, well, how do I want to deal with this? Do I want to be overhedged against them, like extra short delta going into them? And a lot of times they may do that. But then what's their risk? Their risk is that the stock market rallies, like it rips, and they were overhedged on the short side. And I'll just tell you from my own experience, the amount of times I've been screwed by the market going in the opposite direction of my short because I'm overhedged. It's like, this kind of thing that would happen a lot. Look, this is like a vibey thing based upon like pattern recognition, but like I would say whenever I have been short calls that have gotten really expensive, so I'm short them, the way I get effed is the market tanking lower
Right.
because I'm short the calls. I'm worried about the calls getting super bid if we rally. So I overhedge my delta going into them. So I'm running this like long delta book to lean into my calls. And then I get screwed because the market tanks. And so my short calls go away, and then I'm just like riding these long deltas down, right? So like you would tend to get beat up in the opposite direction of where the short gamma was. So, which just leaves me in this place where I'm like, what are you supposed to do with this knowledge that there's a bunch of short gamma down there? Because if you lean into it, you expose yourself in the other direction. Um, so and one of the other things that happens is you not only expose yourself in the other direction, there's a very good chance that because again you're running relatively vol neutral books, if I'm short a bunch of downside puts, yes, I might be long single stock puts, but I'm probably long upside calls because I'm not just naked short S&P Vega necessarily, right? Like so I probably have some like weird risk reversal on, or some long upside calls. So if I lean super short into those short puts and the market rips higher, I get worked on my being short too many shares against the puts. I also get worked if those calls that I'm long, if their vols get pounded even more than like they're probably already kind of cheap calls because
Sure.
that part of the skew has gotten kind of maybe might have been kind of hit, but like they can underperform that too. So like I get really crushed on the up move where like I lose not only on directional shares, I lose on the vol on the options I actually own getting hit. So it's very difficult to like be able to predict what is going to happen on the surface net of what's already priced into the surface. Like that's the difficulty. Uh, so I guess it's like I'm not really sure how people are supposed to take this information. Like if you're like, well, if we go down there, we're going to be more volatile. But I don't know that kind of thing is I don't know if that's like what we call as like value over replacement information. Like, well, I already knew that if we go down there, we're going to be volatile. I'm not going to look at the skew and tell you that. But it's another. So maybe at the margin, it could be the kind of thing that helps portfolio like Delta One portfolio managers. I don't really. I just don't. I don't see it. Like, and I don't see the. But again, there's so much talk of that online, and some of the people that are in that doing that stuff, I know that they're smart people, so I don't like to discount things if I haven't done the work. So it's not fair of me to like, but I'm just giving you my vibe, like my like impression from what I know.
Yeah, and really that's the basis of the question, and it's also due to that same fact that there are sometimes smart people that seem to be talking about some of this stuff. Part of me is always curious if like it happened to be the kind of thing where they mentioned it, then it became part of their brand, and then they kind of have to lean into that in order for the like, I don't know, because it always just seemed strange to me to like prop it up quite as much as it seems, but I also have no idea. So that's why I ask people smarter than me what their idea is. And then hopefully sooner or later I could piece together a somewhat intelligent position that I yet do not have. Now, you mentioned another thing that I'm super interested in. Funny enough, right before we started recording, I said that there was something I wanted to ask you about when we started, which 48 minutes in now I will ask you because there's a perfect preamble. Right before we got on, I was looking at a 0 DTE trade that I had on in S&P. And I run a couple different things in there. Long story short, I pick up on periods where it seems like the last 30 minutes, 15 minutes, I can kind of get more scalped because I track it, that we start to get like little runs. And depending on when you enter and how you trade your 0 DTEs, especially I'm typically on the short vol side, that last 2 minutes can undo the preceding X hours. So I have a specific system built, and every once in a while I'll look at it and I will override the system in terms of like what I'm optimally supposed to do versus like what I'm seeing. And I'm always super hesitant to do that because I know that the human brain is always trying to find patterns. It's super fallible. So rather than overriding and just looking back in confirmation bias saying like, oh yeah, this worked out, I crushed it, I started tracking it. And every single time I override the system, I log it. And the system overrides so far. It's like 300 and something samples. Again, it's zero DTEs, so there's a lot of samples, but it has a exceedingly high success rate in terms of the better decision based on what ended up happening. You had mentioned pattern recognition. I have spent a lot of time trying to figure out why sometimes when I'm looking, I decide to override, and other times I don't. I try to decode everything. I try to look at the move the day before, the way vol, everything. And I can't fucking figure out why. Sometimes I look at this and I'm like, this just seems like something that I need to do something on. What is that? And is there a way that you've found to crack the nut on trying to parameterize some of it so that I can at least try to like integrate it into a plan versus how I fucking happen to feel?
So I've I don't know. I've been really I've generally so as a discretionary trader, I was never, I'd have like models, but I I would have models that would have like signals, like what I thought like the right vol should be and all that. But as a pure discretionary trader, I basically use vibes all the time. All the time. Like it's I don't um I think that if you have a very specific strategy that was sort of like tuned on a bunch of parameters and where to the point where you're confident enough to put it in production and you're using it and the sort of the results are reasonable compared to what you thought they would be, then I probably wouldn't try to I probably would avoid overriding that thing and just letting it be what it was doing. And then, so it's almost like I would almost separate, like, I would almost separate, like, is the thing that I'm doing truly programmatic and then I should just leave it alone? Or if it's not, then let me continue to just accept the vibe trading. But and when I say the vibe trading, it's still doing the same thing that you're doing. It's like you are trying to be like, why do I feel this way? I mean, when I was on the desk, a lot of that was, I mean, the solution to it was talking, really. I mean, that's what you did is like you would just you would explain the situation to somebody, and then what happens is you kind of get into this like um it's not sparring, but it's like it's almost Socratic, where you're
Right.
coming, the person's like just keeps clarifying. So so you're saying, so what is it? It's because this person bought them from you, and the last time you saw them, the stock went up after they bought calls, and you're kind of like, yeah, and they're like, okay, and how often have you traded against them? What broker did they come through? Like, it's like, um, what was the vol? Was the vol also high, or the vol also, or did the vol screen high when they bought last time, or did they bid when when you thought the vol was low? Like, it's kind of like trying to rebuild the circumstances of the scenarios as that they were happening, but it's really hard to do this yourself. I think it's just because we can't see our own blind spots, like literally by definition. So it's more of like this banter thing, and I guess that was my solution to this was just I would just talk about trades with people, um, and I think it's hard to do when you're running your own trading strategy that you're the only one who runs that trading strategy. So if you tried to talk to somebody else about it, like it's hard for them to maybe relate because they're not in there all day like doing that. But like when I'm on a desk, like, well, the people next to me all kind of doing the same job, and we all kind of see the same things. We all have like
Right.
similar tools, so we're it's easier to relate. It's probably so, which means it's easier to ask sort of the right questions. It's a funny thing how you can ask the right questions to your neighbor, and they're hard to ask yourself or to be a reliable witness with the way you answer yourself. So And I think that I've just accepted this. Like this is that where that you really have to be okay with sort of like asking somebody else to the best. I mean, obviously you're going to do the best you can as far as like what you're doing, as far as like why am I doing this? What's going like like the logging, the notebook, all that stuff. And I would say when I first started trading, my first few years, I kept a notebook, and I would say, at this, at this time in the day, I sold 2027 Delta calls. The stock price was here. It was at this implied vol. The open interest was this. And then if I got a chance to close those and it was a big trade, well, now that was useful because because something like you might have got into the trade when it was chunky, and the question is like, are you going to get back that trade in a chunky way too? Meaning that the customer either came back and closed or they rolled. But sometimes it doesn't happen, and like you actually never get them back, or you missed the trade where the person came back and sold them, and like you weren't on the ticket, you passed, you didn't get the look, whatever it was. But like over time, you'd kind of like build up these logs. And that was just like, I did it for the first few years. I probably didn't do it for like probably the first quarter of my career. I kind of did that, but then I kind of stopped doing it. And for better or worse, maybe I should have kept doing it. But uh, I would say overall, I was pretty comfortable with the whole like discretionary aspect to it and being okay with, you know, it was all overriding all the time, I would say the thing that you would get back all the time, it was a lot of like, I feel weird about this. Um, like this feels like a trap kind of thing. Like, um, I kind of I've done this example many times, but like when USO traded at a premium in normally like the ETF like goes premium, whatever, you can be like, I'm gonna sell these vols, and then you're like, this kind of feels like a trap. Like what's going on? And then you have to like slow down and like think through the problem a little bit more. And I think it makes a lot of sense to sort of uh, listen to yourself, because what's happening is like a bunch of things that you don't understand that are happening in your intuition. Like it's just, and you have to trust the fact that sitting there and looking at markets all damn day, yes, they can fool you, but also you are perceiving something with your senses that are that you're not able to actually log, but it's being logged somewhere. And people can, it's one of those things where it's like people push back against that, but it's I don't know what to tell you. It's like I I've watched many people do very well, but the thing that's common about the people is they have a ton of reps. And I think at the end of the day, that's probably all it is like you can trust your intuition if your intuition has earned the right to be trusted by having lots of like reps. So it's one of those things that, but it sounds elitist to say that. Like you got to do this for a long time and then you can trust yourself. But I don't know what else to tell you.
Well, it's funny because the way that I've approached stuff is like pretty regimented. I just try to like box a standard process around like ideation, scoping, planning, testing, live testing, then start moving stuff. And I know the way that the human brain likes to look for patterns, how fallible it is, but also how powerful it is in the same capacity. So I've always found like those sensations fascinating, which is exactly why I started tracking them, right? Turn into a science experiment, see if this is actually net value add or not. But the thing that you said towards the end is something that I've also found difficult to explain to people, because I mean, you've been trading longer than I have, but I started in 2007. So I've also been doing it for a minute. And there is a weird spot that I've found where it feels like you can start trusting yourself to not make a lot of those mistakes that you might otherwise not be aware of, right? Easy part in this example is feeling some sort of way about S&P getting out, then it does the thing that I thought it was going to do and being like, oh yeah, I knew that was going to happen, right? And it's like, the funny thing is when I look at what happened today, I say to myself, like, I have no fucking idea if it was going to happen. Just thought that it might, and it felt like it was more likely to. So then the decision's made. Now, when you're describing that kind of concept to people, though, and you actually framed it really, really well, the idea of like you can trust your intuition when it deserves and earns the trust. Is there a way that you can conceptualize that for people? Like, the question I would have if I were them is, how do I know if I'm at that point?
Um, I think at the end of the day, it kind of comes down to like, if you've done a lot of, just if you've done a lot of trades. Hold on one second. Let me close the door here.
Of course. Right.
Mhm.
We back.
Yeah. So, yeah, how do you know that you're at that point? Well, you probably, first of all, there's no amount of like, there's no time where like self-doubt doesn't live like within you, right? Okay, you never like escape self-doubt. This is like the nature of the game. Like, and so I think that's good and important because paranoia is a survival mechanism. So you need to kind of be paranoid. Uh, but I think at the end of the day, it's what I find is if you're doing a lot of trades and things are going well, it's like the way these things work is it's kind of hard to do lots of trades because trading costs you something. Like there's slippage, there's like adverse selection, like you in other words, like there's like an ante. You could think about it as like there's an ante in the market. Like you may think like it's not cost, but like you are losing a little bit in terms of execution on every single trade that you do. So you are paying an ante all the time. And uh it's very hard sort of like over many, many, many trades. And it's like I think that's the thing is like I mean, I traded a lot of contracts. Like like at the fund, like I was trading tons of contracts. And it's like I've traded a lot of I've traded I mean, we're talking about like close to 100,000 like a day. This is like so it's kind of hard to trade that many contracts for a long time and just like you're not losing. Like if like if you're winning to it, it's not random. I mean, it's like so that's one. The other but that doesn't mean you don't go through losing streaks. And so the losing streaks are really the things that test you. It's like, okay, because you're always kind of like, whoa, is the thing that I've like figured out or is what I'm doing sort of like solved? Did this get more competitive in some way that's like it happens invisibly? Like it might be like God, this all seems like way harder. Like I normally when somebody came in to buy these things, it's like I used to be able to get like 3 cents of edge on them. And now I'm like it feels like it trades for fair value every time. So it's like there's more there's like does everybody know about this trade now? Is there more risk capital that like maybe there's the same number of people trading, but the amount of risk capital they're willing to put behind the trade has grown. Maybe people are willing to accept worse risk reward. That also happens. So all of these things can happen. And it doesn't, so it's like you're understanding the situation the same, but it's gotten more competitive. Like people will trade it for less. So that's that tends to be the thing that's actually happening so much more so than like I don't know what a good trade is anymore. I never really I don't think like that is this a good trade? Is that a bad trade? Was kind of like not the hardest part. It's like it's like getting on a good trade is the hard part. It's not like necessarily knowing that the trade is good or bad. So the uh, so I would say that in that when that happens, the thing that I've found that's really important is like this back to the basics thing because you need a way to like re-center yourself when you're running kind of bad. And so my back to basics thing is that I become stricter about my discretionary, the way I'm trading discretionarily. So
Mm.
like, for example, I let less vibes come into the entire equation. If you're running, you might be running good and you're confident and you're like, man, whatever. I feel like I'm seeing the ball really well right now. So you kind of get a little bit more bold and like you're like, oh, you know what? Like I don't normally even trade that thing, and I'm gonna go like over there and I'm gonna buy a bunch of calls on that thing because like I'm just uh, for some reason I think I know something. When you're running bad, you pull everything in and you start to say, you know what? The only reason I'm going to buy this is because this other thing is bid here. And in other words, like I'm really going to narrow my focus and be like, I'm buying this because this is bid here and I like that and I'm comfortable with that spread. And I'm going to do it at a size where I can sort of like be roughly even risk on both sides of this rather than what I would often do is like I might say hey, this thing is cheap because this thing is bid here, so this other thing is cheap and I'm just going to buy everything that's offered here and I'm not even going to hedge it. I'm not going to worry about it. And like I'm not going to like complete complete the not an arb but complete the relative value. I think this is the good side. I'm just going to buy the good side and not trade the fair side and leave it at that. And I would be less inclined to do that when I was running bad. I'd be like, I should just do the basic blocking and tackling because I need to, I need to like know that, I need to rebuild my confidence. I need to know that the basics are working. So I think that's almost, uh, and I don't think that ever goes away. Like you can get really, really experienced. You're going to have a bad run, and you're probably going to need to recenter yourself, go back to the basics in some fashion. So I think that's just a good habit is to just like know how to get back to your fundamentals. Um, so yeah, uh I guess that's all I can think about that
Yeah.
for that.
No, it's super useful. And I appreciate the thought where a lot of the stuff that we're talking about anyways, it's a little bit conceptual in nature, but I think there are things that impact especially retail traders at different points. And sometimes it's actually like really difficult to navigate, especially on your own. So I think it's super useful. And I know that we're at time. I had one more question for you. There's a really, really common concept that gets thrown around, especially for the option sellers, the Theta gang crowd, that kind of thing, where there's a perception that Theta is their edge. Could you talk about that?
Yeah, I mean, data's not an edge. It's a Greek. I mean, I don't even know, like, okay. Theta
Have
is
you
just
hold on? Have you heard this before?
yeah, I mean,
Okay.
it's just the
Yeah, yeah.
cost of gamma. It's just the
Right,
cost of
right.
gamma. I mean, it's so like even if you uh okay, so here's where you can make it really obvious. If let's say that you have this is the example I always kind of give to this because it's so obvious. If you have a stock that's $100 and the stock has like a 25% chance of going up $50. Okay. So what's the 110 call worth? So the 110 call has a 25% chance of being $40 in the money. Okay. So the 110 call is worth um it's worth $10. So like if you sell the call and now like it may decay. I guess that's the first question is like, how does that option even decay? Like, let's say that a little bit of time passes every day, and then like you don't know at what point, in some point, that it could make that move. But my question is like, if you sold the option for like 950, like the option has theta. But do you think you have any edge? Like you have negative 50 cents edge. The options were $10. You sold it at 950. Like what I can't even understand like how you can look at that and be like the theta is an edge here. Like you sold something worth for less than what it's worth. So And the other way you can look, in a more complicated way of looking at it, but it's still not even that complicated, it's just recognizing that like gamma, your gamma P&L, there's a formula for it. It's one half your gamma times the stock price move squared. Your gamma P&L and your theta P&L, your gamma P&L is always positive. You own an option and the stock moves, that number is always positive because the move is squared. So it's always a positive number. The theta is a negative number. It's like options decay every day. If the theta is greater than the gamma, then you won to being short, and vice versa. So they're two sides of the same coin. If so to say that the theta is an edge is to say that the stock is not going to move.
Hmm.
So if the stock moves, you've lost. Like, I mean, if the stock moves more than what was implied in the theta, basically like because the gamma number and the theta number are both derived from what the vol number is. So the theta is just a hurdle for the gamma. That's all it is. It's the cost of the gamma, the hurdle for the gamma. So uh, it's I don't even understand. Like it sounds so incoherent to me to say that it's an edge when it's just a hurdle.
Now, one of the common retorts is, I think, typically conflating things. Because normally, if that we open with that theta is an edge, we hear it's not. Then a slightly more advanced option trader will say, well, isn't implied volatility typically slightly higher than realized vol?
It is. So that's saying something different. That's saying that there's a risk premium to option prices. And that is a perfectly fine statement. But that's not enough of a statement to be like, I can make money knowing that because, well, how do you know that because the premium is not always the same size and it's not always the same, it's not always present all over the term structure. It's um it is it's like it's not this constant piggy bank that you can take. And the reason is why how could it be a constant
Right.
piggy bank? Like if it was, then everybody would just do that. Like, I mean, all these, I mean, we see how much, look how much money people get paid to go work for Ken Griffin. It's like, if this thing is just free money sitting there, aren't these guys going to go take it? Like, what? It's not like they don't have access to the option markets. So there's no reason to think it's simple just because it's there, which is the same thing. So, like, okay. This was something I was just kind of like working on a little bit this morning. I was just napkin stuff, okay? But let's say that um, we want to go with this risk premium idea, okay?
Okay.
So let's say you got a $100, you have $100 stock, and it's 30 vol. It's a 30 vol $100 stock. And we're going to say that we're going to just say that the vol is overpriced by 10%. So it's going to God told you that it's going to move at 27% and its implied vol is 30. Okay. So if that's a 1 month straddle, that straddle is going to be okay, zero point 0.8. Remember, it's zero point 0.8 of the standard deviation is what the straddle's worth. So that is $100 stock. So the one standard deviation is $30. Zero point 0.8 of 30 is $24. But that's for 1 year. So to get it to 1 month, we can't just divide by 12. We have to divide by the square root of 12. So we have to take, so we've got a $24 straddle divided by the square root of 12. The square root of 12 is, well, the square root of 12 is somewhere in between 3 and 4. So that's, we'll call it 3.5. So you have a $24 straddle divided by like 3.5. That's about $7. Okay. So you have a
We'll take your word
$7.
for it.
Yeah, it's about $7. Okay. So you have a 1 month $7 straddle. Okay. We say that the vol is 10% overpriced. So that straddle has 70 cents in it of edge in selling it. We'll say it's like the true value of the straddle should be 630 and it's trading for 7, so you sell it for $7. Okay. That's 70 cents of edge. You're going to hold it for a month. Okay. There's 20 trading days in a month. So you're gonna make 70 cents divided by 20 days. So you're making like uh what's that, 14, it's like 14 cents a day, 14 cents a day on that. And then you're paying slippage on that. Uh it's four, let's say it's 14 cents. Did I do that right, by the way? 70 cents divided by,
I'm just watching you. I'm just
yeah, yeah,
here.
yeah, yeah, yeah,
I'm here to be the pretty face.
yeah, yeah, yeah. No, that's about right. Sorry, it's more like it's a smaller number. It's here, let me pull up a calculator real quick. I want to,
What are we doing? I got one right here.
yeah, I got it. It's
Okay.
so you have 70 cents divided by 20 days. Sorry, it's three and a half. I'm
Yep.
doubled the wrong number. So uh 3.5 cents a day, okay, of edge. Now, let's say your slippage is 10 basis points on your delta hedge. You're gonna hedge, and you're just gonna hedge once a day, and so what happens is your slippage is gonna end up being something like it's 10 basis points, which is a dime, but you're not hedging the full amount every day because like your adjustments are like, it's like the straddle had 20 deltas today, it's got 24 delta today, whatever. So let's say you have 10 cents of slippage, but you're only trading 10 deltas worth a day. So that'd cost you a penny. So now, right now, we're now down from like, I'm making 3.5 cents a day to like 2.5 cents a day on this trade. And then, so the question is like, it's 2.5 cents a day. And then I say like the Vega of that option is something like 24 cents. It's about 24 cents. So, and we say vol can move around, let's say vol can move around 1 point a day on average, like it oscillates 1 point a day. So that's 24 cents of variation. And then your realized vol is going to bounce around reality to some degree every day. There's going to be some gamma theta like tug of war P&L every day as well. That's probably another dime worth of variation. So here's the situation. You are making 2.5 cents a day, and you have about 35 cents of variation a day in the trade, with um, part of that coming from implied vol moving around, and part of that coming from the tug of war between realized vol and theta, like your gamma versus your theta. Okay. So you are making, so the risk reward here is about, I'm making say 3 cents and I got 30 cents of variation a day. So it's 10 to 1, right? It's actually not like uh that different from if I just bought the S&P, because what is the S&P? You make it works out, so you make about 3 basis points a day, right? 3 basis points a day over 250 trading days is 7.5% a year. Whatever. 4 basis points a day. You make 10% a year. And what's the daily standard deviation of the S&P? It's like 100 bips a day. That's about 16 vol. So, you're getting here that's well, I guess that's like 25 to 1. So you're getting a little bit better you're getting 10 to 1 a day versus 25 to 1 a day on the S&P in terms of like risk and reward. Um, so so that's 20% a year rather than 10% a year trading the options, let's say. But you got to manage this. You have to do a bunch of work, and you're uh and it's also not like, it's not necessarily, it's like worse taxes, right? Because you're trading, so you're getting short-term capital gains tax, and like your S&P, you can just buy and hold that thing. So like your risk reward, like you can, there's something there, right? If you think that there's a 10% premium of volatility to realized in the marketplace, there is something there. But is the juice sort of like worth the squeeze, as far as like you now have to like go do that, all the like you have to run a business sort of around that. And that's kind of the point. It's like, do I think that there's something there? Yes. Do I think it's a lot of work to do it? Also, yes. So it's not this passive thing, and like we don't really know. And then it's like there's the other question of like how confident are you in that 10% premium? Like, if you are only getting filled when when the premium is 3% and you don't get filled when the premium is 15%, like you're being sort of like you're only getting filled when it's not a good trade. So that's like goes into it as well. So it's like if the 10% is sort of like your best case scenario. So that's the reason you have to build a whole sort of like operation around it because you need to try to like be in the weeds to separate like, am I, when I'm trading, is it like worse for me when I actually get filled versus not? And that's that's kind of like I think there's something there. Um, First of all, I know that there's something there because I know there's people doing this. Like
Sure.
there are retail traders. I mean, you're doing this like retail traders. I know successful retail traders, but I guess my point is it's a job. So if you're going to do all the things that you're doing, then it makes sense that there could be money for doing it. But this concept of like, I'm just going to sell these options and walk away and like it's passive income and all that, I think I just don't think it's that easy. I think if it was that easy, there would be there would be a lot more sort of like professional money managers kind of doing it. And you'd have to have a really good counter argument for why there isn't. Like why that edge should be sitting right in front of you.
It's one of those interesting things because I also find, even going back to the original question, like some of the times when I've had try to have conversations with people about like theta is not an edge, it's almost like talking to a flat earther, where it's like you can kind of show a lot of different things, but it doesn't necessarily resonate or connect. And it's almost like a belief system, which is even more bizarre, where it's like, you're taking away Santa Claus. I want to think this thing exists so bad, therefore it exists.
Let me,
So
I'm gonna do this thing. I'm gonna do this thing where like I borrow a story that I heard on another interview, but it's
perfect.
because it's great. So there's this it was a guy from SIG actually who described this he kind of like helped build the education system there, and he was talking. There's a very famous like Kahneman and Tversky sort of like study where it's almost like a mathematical optical illusion. So the question is you tell somebody that there's a bat and a ball, and the bat and the ball together cost $1.10, and the bat costs $1 more than the ball does. Okay. And the question is like, how much the ball cost? And everybody says 10 cents.
That's what I
But
would
like,
say.
right. But that's like everyone's like gut reaction. It's 10 cents. And that can't be true because if that's 10 cents, then the bat is $1.10, and $1.10 plus the 10 cents is $1.20. That's right. So the ball is 5 cents.
Right.
Dollar five and $5. But you have to slow down to sort of like to be able to do this. And this is like one of these, this is like a very funny optical illusion because it works on like almost everybody if they don't stop for a second. Like it's basically it was like his good demonstration of like system one versus system two thinking. Like you got to
Right.
switch to system two to get this. Anyway, this particular study has been like the person I had listened to on the podcast. He had mentioned that they have like redone this study. There was like a couple of researchers that did this study with like 80 different variations on it. And I have read the paper for this. They're really trying to like understand where in the process people are sort of like tripping up on this. But what's crazy is some of the variations. So okay, most people get this, they get it wrong. And then they'll do variations where they ask the question and then they say, are you sure? And that causes people's accuracy to go up a little bit. Okay,
Right.
fine. But it's still less than 50%. Then they do a variation where they say, have you considered that the ball is worth a nickel? Okay. So now it's like they kind of gave you the answer, right? And then the accuracy, believe it or not, only goes up to like 2/3. So like you'd think it would go to like 100, but it goes to 2/3, right? Then they do another one, a variation where they say the ball is worth a nickel. Write a nickel for the answer. And then it's like the accuracy only goes up to like 75% or something like that. Okay. So now, and it's not like the researchers are like just, it's like they're like trying to understand, is it
Right.
like possible that people think that they're being tricked? Like, what is going on here? But I will just tell you that the conclusion of the paper is like there's just a certain percentage of the population that they call the hopeless. That's where they kind of landed on this. Is just like they are unable to like have their minds changed. And I think about that. I think about that story a lot, man. Like, like you'll
The
try and you'll
terminology
try,
is
and
so
sometimes
good.
you're just like, I'm just talking to a wall, and it's over. Like, there's no. It's like I'm like, hey, man, I'm happy for you. Like, like it's all good. Like, believe what you want to believe, and that's it. And so, like that study kind of tells me quite a bit about like how much energy I should expend.
It's so awesome. I love that, like the hopeless. It's just such a great term.
Yeah, I can send you the paper.
Yeah,
It's
actually, I would love to check it out because those kinds of things are fascinating to me. I love SSRN. I love going through there and just kind of pulling up different piece of information. Like, have you heard of Barbara Leonodine? They're out of Berkeley, but they do a bunch of like investor behavior research, and it's the same just stuff that I know and most people probably intuitively know, but it's similar variations of that. They do a test with like cost basis, effectively a scenario where your cost base is like way below, and then you sell it higher, then another one where you're below, you sell it halfway, and then you sell the rest of it halfway, and like what's the difference in those? And like people, that fucks people up massively. So yeah, the hopeless. I really love that so much. It's so in the Marine Corps, we call those like the window lickers, or like the lowest common denominator. These are like the people that you just got to get them where they need to be, tell them have a great day, and then move on with your life. So I now know the term for traders. Beautiful.
yeah, window lickers is cold, man. Damn.
Well, we're not necessarily known for our warmth.
No, no, no.
So
But yeah, I
I
get
had a
it.
buddy, I had a buddy in the like operations section. It's called the S3. And I would go visit him because he was always the just most disenfranchised human being. And I don't know why, but I fucking loved it. So every time I had a chance to like go visit him, I'd be like, dude, how's your day going? And he would just bitch about everything. Motherfucker, this, that, And for Halloween one year, I walk in and they have a bowl of candy for Halloween. And on the candy, it literally says, not for fat Marines. And I was just like, I fucking love this place. These are my people.
Amazing.
So we actually covered a pretty good bit of ground today. So I appreciate the information, the context, obviously going into the detail. The hope is to try to like explore some of this a little bit more. I'd love to have you on again. And I'm thinking for a follow-up, it could be really cool to actually talk about some of the like market effects or dynamics that are viable for retail and give some concepts around like how to build something around those ideas and how you envision that. But that is for another time, Kris. People can find you at Moon Tower. You have your Substack. I can throw links to all that. Anywhere else that you want to send people?
There, they can go to moontower.substack. Everything, the whole world opens from there.
And then the hopeless, they'll just get lost. So we'll let that
So
be what it
it's all good.
is. Great seeing you, brother. Thanks for hanging out.
All right, thank you.